Are corporate landlords, i.e. institutional investors like Invitation Homes and Blackstone, going to crash the housing market in 2023? There's a plausible argument, and it goes like this. Home values are tanking, rents are shrinking, and interest rates have ballooned. It's only a matter of time before these massive firms stop turning a profit and or end up underwater on their loans. When that happens, the fallout will be huge. Hundreds of thousands of single-family homes will flood the market, crashing home values that were artificially propped up by these mega buyers in the first place. So, question number one, are institutional investors really that big of an issue? According to our own Congress, the answer is an emphatic yes. In 2022, the House of Representatives Committee on Financial Services ordered its Subcommittee on Oversight and Investigations to investigate institutional investors. The subcommittee published an explosive memorandum on June 28, 2022, with a summation, quote, before the financial crisis began in 2008, investors owned about 10 million single-family residential homes, and the market was dominated by smaller investors who owned 10 or fewer homes. As late as 2011, no single investor in the U.S. owned more than 1,000 homes. From 2013 to 2017, the largest institutional investors consolidated their holdings into two companies, Invitation Homes and American Homes for Rent, resulting in larger portfolios for large corporate investors. Large-scale investors have continued to increase their footprint in various local markets since then. For example, in the third quarter of 2021 alone, institutional investors bought 42.8% of homes for sale in the Atlanta metro area and 38.8% of homes in the Phoenix, Glendale, Scottsdale area. The subcommittee identified the 5 largest owners of single-family homes in America, who together own over 300,000 houses. Fortunately for us, 2 of these 3 firms are publicly traded, meaning their audited financial statements are available for us to review. So instead of just posing the foreboding question, in this video, we're answering it. Will institutional investors crash the housing market in 2023? I'm Jon Schwartz, a real estate investor with half my net worth in real estate holdings, so getting this stuff right is much more important to me than getting clicks. This video is the second in a 3-part series that examines whether investors could crash the housing market in 2023. Part 1, which I'll link to in the description, assesses the threat presented by iBuyers, who are almost definitely going belly up this year. And Part 3, which I'm beginning to research now, looks at the tens of thousands of mom-and-pop investors who flooded the market last year. And the early research does not look good. Subscribe so you don't miss it. In this video, we're going to analyze Invitation Homes' Q3 2022 financial statement, looking at their balance sheet, their cash flow, and their debt. And to confirm or refute the trends we find in Invitation stocks, we'll also dip into the financial statements of American Homes for Rent and Tricon Residential, a relatively small institutional investor with a portfolio of 30,000 homes. In this way, we'll get a sense for the industry as a whole, and hopefully, you'll get enough of an education in how real estate investments work that you can do your own analyses in the future. Though first, to please our Robin Hoodlums out there, let's take a quick look at Invitation, American Homes, and Tricon's stock performances. In 2022, our 3 institutional investors didn't perform as well as the broader S&P 500, but they held their own against big tech and certainly didn't collapse like the iBuyers. However, it's important to note that Invitation, American Homes, and Tricon are all reliable dividend stocks, meaning shareholders earn cash dividend payments every quarter. With a dividend yield well above the S&P 500 average, institutional investors appear to be doing pretty well. But let's see what fissures we can find in the financials. We'll start with Invitation Homes' balance sheet, which shows us the value of their portfolio, $17.1 billion, and their total debt, $7.75 billion. This indicates a leveraging of 45%. American Homes for Rent is leveraged 39%, and Tricon Residential is 47% leveraged. So right off the bat, we can see that institutional investors are operating with very low leverage compared to the typical home buyer, who buys a home with 80 to 95% leverage, that is with a 5 to 20% down payment, typically. Institutional investors have significantly more equity, meaning they have a lot more options prior to a fire sale if profits start to suffer. But how are those profits looking? Before we dig into profit and loss statements, let me give you a quick lesson in long-term real estate investing 101. Here are the fundamentals underneath every long-term real estate investment. Your top line number is called gross revenue or gross income or just rental income. This is the rent you collect from your Airbnb or apartment building, or in the case of Invitation Homes, 83,000 single-family houses. From revenue, you deduct operating expenses. This is the cost of operating your portfolio. Expenses include property taxes, insurance, ongoing maintenance, improvements, landscaping, property management, legal fees, everything involved with keeping the portfolio in good working order. The result is called net operating income, or NOI. NOI is the net income you generate from operating the portfolio. It's how much money the property or properties actually deliver to you at the end of the month or quarter or year, whatever you're measuring. And NOI is also important because with your NOI, you first make your required debt payment and then you take your profits. Real estate is a leveraged investment, so there's almost always some debt or mortgage payment to make. NOI first goes toward your debt, and then whatever's left over is profit. So let's take a look at our institutional investors' fundamentals. Right after you take 1 second to hit that like and subscribe button. I'm making these videos to educate fellow housing market participants, whether you're getting in as a buyer, jumping back in as a seller, or growing as an investor. I'm trying to build a savvy community here, and the best way you can help me, if you find this video helpful to you, is by hitting like and subscribe. My sincere thanks. Okay, let's look at the top line, revenue. Rents declined nationally in Q3 2022, but Invitation Homes revenue actually grew from Q2 to Q3 by 0.9%. From $481 million to $485 million. American Homes for Rent enjoyed 1.7% revenue growth from Q2 to Q3, and Tricon enjoyed sequential revenue growth of 2%. How? How is it that these companies saw revenue growth in a quarter when rents fell? Let me explain. In a given quarter, most tenants are somewhere in the middle of their lease and pay their usual rent. Some tenants have to renew their leases and face a rent hike. Some tenants move out and are replaced by new tenants, and of course, some percentage of the portfolio is vacant. In the case of Invitation Homes in Q3 2022, 2.5% of homes were vacant, 6.2% of homes got new tenants, and while Invitation doesn't report these two metrics, we can assume about 20% of tenants faced lease renewals and 70% had normal quarters. Now, whether your portfolio is a single fourplex or 83,000 single-family houses, your revenue growth is based on the entire pie. Existing tenants see no rent hikes or declines. These 70% of tenants are a buffer against market fluctuations. Rents climb and fall, but the bulk of your renters will pay a consistent rent each quarter. In their financial statement, Invitation reports that lease renewals saw an average rent hike of 10.2%, and new leases saw an average rent increase of 15.6% over the outgoing tenant's lease. But how could new leases and lease renewals grow so much in a quarter in which rents actually fell? The answer is pretty simple. Most leases last 12 months, so month-to-month fluctuations in asking rent don't matter. What matters is rent movement over a 12-month period. For example, rents fell every month from mid-2020 to early 2021. But if we look at the annual rent growth numbers, we see they never went negative. This is why institutional investors tend to report slow but consistent average rent growth quarter after quarter, which translates into slow, consistent revenue growth quarter after quarter. Looking at American Homes for Rent and Tricon confirms the trend. So now let's talk about operating expenses, because Invitation's expenses also grew from Q2 to Q3 to the tune of 6.3%. When expenses grow so much faster than revenue, the result is a decline in net operating income, NOI, of 1.5%. So is this the true Achilles heel of large-scale single-family home ownership, that inflation outpaces rent growth, eating into NOI until there's no profit left? Maybe. Looking back over the last year, we see that Invitation's expenses fell or stayed flat as often as they rose. And if we look at NOI over the last year, we see that it has risen every quarter. Looking at American Homes for Rent, we see expenses fluctuate up and down while NOI consistently grows. And for Tricon, the same. So the story of 2022, at least, is that rents have consistently beaten inflation. 2023 might be a different story. If inflation remains high and we see year-over-year rent declines, institutional investors might see NOI shrink, which would imperil their ability to pay their debt, which we'll discuss next. And we'll start this conversation with a quick long-term real estate investing 201 class, specifically the difference between residential mortgages, which regular people use to buy houses, and commercial loans and corporate bonds, which institutional investors use to buy houses. By understanding the advantages and disadvantages afforded to institutional investors, we can better understand their risk of default. For starters, residential mortgages have long terms, typically 30 or 15 years. Commercial loans are much shorter, usually 3, 5, 7, or 10 years. This exposes institutional investors to more risk as they have to secure new debt every 3 to 10 years. With the expectation of a liquidity crunch in 2023, institutional investors who need to refinance may face a serious problem. Secondly, residential mortgages are fully amortized, meaning the loan is paid off in full at the end of the 30 or 15-year term. Commercial loans aren't fully amortized, so only a small portion of the principal, if any, is paid off over the 3 to 10-year term. This means institutional investors have relatively lower debt payments, but again, they have that refinance risk to deal with. What if they have $1 billion loan due and a liquidity crunch makes it impossible to find a new $1 billion loan to pay off the first one? Thirdly, residential mortgages tend to have a fixed interest rate, though mortgages with floating rates during the first few years have become popular in 2022. Commercial loans, on the other hand, often have floating rates, meaning the loan's interest rate is pegged to a fluctuating real-world rate, like the prime rate or LIBOR or SOFR. This gives institutional investors rate risk that residential borrowers don't incur. Fourthly, residential mortgages don't have covenants. They're simple. If you pay your mortgage, you keep your house, end of story. Commercial loans and corporate bonds often have covenants, which are requirements that must be met in addition to repayment of the loan. Covenants typically require the borrower to have a certain ratio of income beyond what's necessary to repay the loan. This protects the lender from default risk, but it amps up the stakes for the borrower. For institutional investors, it's not just that they have to make their debt payments, it's that they have to maintain enough income to honor their covenants. Break the covenants, and the debt can be recalled. And finally, we have one advantage for institutional investors. Residential mortgages are secured by the house, meaning that if the borrower doesn't pay, the bank gets the house. Commercial loans typically are secured by property, but corporate bonds aren't. An unsecured corporate bond is a loan made to an institutional investor backed by nothing. So while the fallout from not paying an unsecured bond isn't good, it also does not mean foreclosure. So, what can we glean from Invitation Homes' financial statements about the corporation's debt? Fortunately for us, quite a lot. Invitation Homes is carrying $7.7 billion of debt. 7.2% is due in 2025, 40.4% is due in 2026, and all the rest is due in 2027 or beyond. So a 2023 liquidity crunch will not be a problem for Invitation. We can also see that only $2.6 billion of Invitation's debt is secured to houses. The remaining $5.1 billion is unsecured debt. Another plus for Invitation. We can see that none of the secured debt is floating and only 0.7% of the unsecured debt is floating. The rest is fixed, and the weighted average interest rate for all of the debt is 3.6%. And remember those covenants we talked about? Invitation is knocking them out of the park. Total leverage ratio needs to stay under 60%. It's at 31.1%. Their unencumbered asset ratio needs to stay north of 150%. It's at 329.6%. Debt service ratio, which my investor audience will be familiar with, needs to stay above 1.5. It's at 4.4. So Invitation Homes has mostly unsecured debt, fixed at 3.6% and not due for years. That's why they were able to take such hefty profits in Q3 2022, specifically $40 million in income for the company billed as management, general, and administrative, and $79 million for shareholders, paid out as 22 cents per share. American Homes for Rent carries $4.4 billion of debt, 0.5% of which is due in 2023, and 77.7% of which is due in 2027 or thereafter. $1.9 billion is secured, $2.5 billion is unsecured, and it's all fixed at an average 4% interest rate. American Homes is also kicking ass with their covenants and ended the quarter with about $27 million of company income and $50 million for shareholders. Tricon is more opaque about their debt, but they're carrying an effective interest rate of 3.36% on their U.S. single-family homes. Because Tricon owns houses in the U.S. and Canada and owns multifamily buildings and private funds, it's really hard to identify what line items are company income, but the bottom line is that Tricon had $177 million for shareholders in Q3 2022. And here's what it comes down to. Institutional investors are not typical home buyers. They're insulated. With longevity, they've built up equity. With scale, they see slow, steady growth even when rents fluctuate. And with access to capital markets, they're nimble with their debt, which is mostly unsecured. None of these advantages exist for mom-and-pop investors. For the tens of thousands of individual investors who got into the market in 2021 and 2022 and now face falling rents, falling home values, and the prospect of recession. Will mom-and-pop investors crash the housing market in 2023? Subscribe and find out in my next video.